Two men, same neighborhood, same paycheck, 10 years apart in the way they think about money. Jim refreshes his stock app before he gets out of bed. He knows every hot ticker, every earnings date, every rumor on Reddit. At 40 years old, he has $60,000 in savings and a mortgage that keeps climbing beyond what he planned. Michael checks one number once a week. Not a stock price, not a crypto chart. Something most Americans have never looked at once in their lives. At 40 years old, he has $400,000 quietly working in the background and a mortgage he locked in at exactly the right moment. Today, you are going to learn what Michael knows, because the bond market is already controlling your mortgage, your savings rate, and your retirement account, whether you understand it or not. Act 1. What a bond actually is. A bond is a loan, not a Wall Street product, not something only institutions touch. A loan. Someone needs money, a government, a company, a city, and instead of going to a bank, they borrow directly from investors. You hand over a fixed amount called the principal. They promise two things back: a fixed interest payment every year called the coupon, and your principal returned on a specific date called the maturity. That is the entire instrument. A piece of paper that says, "Lend me money now. I will pay you every year, and I will return everything on this date." Jim: sounds like something my grandfather would do. Why would I care about this when I can just buy stocks? Michael: because the bond market is $145 trillion. The entire United States stock market is around $46 trillion. Bonds are 3 times the size of stocks. And right now, they are setting the rate on your mortgage. The United States government borrows more than any other entity on Earth. The interest payment on the national debt alone runs approximately $1.05 trillion per year. That is about $2.88 billion every single day, more than the government spends on national defense. Every dollar of that interest comes from tax revenue, and the rate the government pays is set by the same market that priced the home you are living in. The one rule that runs everything. One rule explains almost every bond story you will ever hear. It sounds backward until it clicks. When interest rates rise, the price of existing bonds falls. When rates fall, the price of existing bonds rises. Opposite directions. Every time. No exceptions. Here is why. You buy a $1,000 bond paying 3%, $30 a year. A few months later, the government issues new bonds at 5%, $50 a year for the same $1,000. Now you want to sell your bond. Nobody will pay $1,000 for it when they can buy the new one paying more. You have to drop the price until your $30 represents a competitive yield. At 5%, that price is around $600. Jim: so you just lost $400? Michael: on paper, yes, if you sell. The bond still pays $30 every year and returns $1,000 at maturity. Nothing about the future payments changed, but right now, in the market, your $1,000 investment is worth $600. That is the rule. Everything else in this video is that rule at a larger scale. Act 2. The number that sets your mortgage. Of all the bonds in that $145 trillion market, one matters more than the rest. The 10-year United States Treasury bond. Right now, it yields 4.5%. When your bank decides what mortgage rate to offer you, it does not invent a number. It looks at the 10-year Treasury and asks, why would I lend money to a household for 30 years when I can lend to the United States government for 10 years at 4.5% with zero risk? The answer is, it would not, unless you pay more. So the bank adds roughly 2 percentage points for the risk that you might lose your job, get sick, or default. Today, the 10-year sits at 4.5%. Add 2 points. You get the national average 30-year fixed mortgage rate, 6.52%. That math is that direct. Run it on Jim. He needs a $400,000 30-year fixed mortgage. At 6.52%, his monthly payment is $2,534. Now suppose the 10-year Treasury rises just half a point, a move the bond market can make in a single trading week. Jim's rate climbs to 7.02%. His payment becomes $2,667, $133 more every month. Over 30 years, that half-point move costs Jim $47,898. To see the full range of what the bond market can do, compare two real historical moments. In January of 2021, the 30-year mortgage hit an all-time low of 2.65%. Monthly payment on that $400,000 loan, $1,612. In October of 2023, the same rate peaked near 7.79%. Monthly payment, $2,877. Same loan, same house, same buyer. The bond market moved. The difference is $1,265 every single month, $455,000 over the life of the loan. Jim, the bond market handed me a $400,000 bill and never told me. Michael, without ever sending an invoice. That is how it works. Act 3. The year. The safe part blew up. For decades, the standard retirement advice was simple. As you age, move out of stocks and into bonds. Stocks grow your money, bonds protect it. The classic 60-40 portfolio, 60% stocks, 40% bonds, was sold as the conservative, sensible default. The bond half was supposed to be the seatbelt. In 2022, the Federal Reserve raised interest rates faster than at any point in 40 years. The funds rate went from near 0 to over 4% in 9 months. Apply the rule. When rates rise, existing bond prices fall. The broad United States bond market lost 13% that year, the worst calendar year on record going back to 1976. The S&P 500 fell 18.1% the same year. A 60-40 portfolio lost about 16%. The seatbelt did not catch anyone. It was attached to the same crash. Long-dated zero-coupon treasury bonds, the longest duration safe assets on Earth, lost 39.2%. A Santa Clara University analysis found 2022 was the worst year for long-duration United States bonds since 1754. Not 1954. 1754. The country did not exist yet. Jim, how does a bond fund lose 39%? That is worse than most stock funds that year. Michael, duration. It is the number printed on every bond fund fact sheet that almost nobody reads. Duration tells you roughly how much a fund loses for every 1 percentage point rise in rates. A fund with duration of 6 loses 6% on a 1-point move. A fund with duration of 17 loses 17%. Same rate move, completely different damage. Check the duration on any bond fund you own. If it is above 7, that fund will move meaningfully when rates do. If it is above 15, it will behave more like a volatile stock than a seatbelt. Act 4. The signal that predicts recessions. Here is something stocks cannot do that the bond market does quietly and consistently. It predicts recessions. The tool it uses is called the yield curve. The yield curve plots bond yields across every maturity from 3 months out to 30 years. Right now, the 3-month Treasury yields 3.71%. The 2-year yields 4.09%. The 10-year yields 4.5%. The 30-year yields about 5%. That upward slope, short maturities yielding less, long maturities yielding more, is the normal state. The longer your money is locked up, the more compensation you require. But occasionally, short-term yields rise above long-term yields. The 2-year starts paying more than the 10-year. That is called an inverted yield curve, and it means the bond market expects the Federal Reserve to cut rates soon because it expects the economy to slow enough that the Fed will have no choice. According to research from the Federal Reserve Bank of San Francisco, every single one of the last 10 United States recessions going back to 1955 was preceded by an inverted yield curve, 10 for 10 over 70 years. Jim, so when the curve inverts, I should get defensive with my portfolio? Michael, it does not mean sell everything tomorrow. The lag between inversion and recession has ranged from 6 months to 2 years, but it means pay attention. No economist has a 10 for 10 record. The bond market does. Act 5. The money you are leaving on the table right now. There is one more thing the bond market is doing to you right now that has nothing to do with mortgages or recessions. The national average savings account at a major bank pays 0.38%. Meanwhile, 3-month United States Treasury bills currently yield 3.71%. The best high-yield savings accounts pay around 4.2%. All three options carry essentially the same safety. Treasury bills are backed by the United States government. High-yield savings accounts are FDIC insured up to $250,000. Same money, same protection, completely different yield. Jim holds $50,000 in a standard savings account earning 0.38%. That earns him $190 a year. The same $50,000 in 3-month Treasury bills at 3.71% earns $1,855 a year. The Treasury option pays 9.8 times more on the same dollar. Over 5 years, leaving money at the regular bank cost Jim $8,325 he could have had without taking on a single extra dollar of risk. Treasury bill interest is also exempt from state income tax, which widens the gap even further in high-tax states. Jim: I have had that $50,000 sitting at my bank for 3 years. Michael: then you already know what it cost you. The bond market was paying you this whole time. You just were not in the room. Close. What Michael knows that Jim is learning today. 2 men, same neighborhood, same paycheck. Jim spent a decade watching tickers, refreshing apps, and never once looking at the market that was quietly setting his mortgage rate, draining his savings, and reshaping his retirement. Michael watched one number and used it to make better decisions across every area of his financial life. The bond market is not something for institutions or retirees or Wall Street desks. It is the invisible engine running underneath every dollar you earn, spend, borrow, and save. Your mortgage rate lives there. Your retirement safety net lives there. The recession signal lives there. And the gap between what your savings account pays and what you could be earning without any additional risk, that lives there too. The people who understand how bonds work are not smarter than you. They simply stopped assuming it was someone else's subject. Now you know what they know. Jim: okay, so what do I look up first? Michael: the 10-year Treasury yield. 5 seconds, and now you will know exactly what it means. If this connected the dots, hit like and subscribe. Every week, we run the real numbers on the systems quietly running your financial life. We will see you in the next one.